The views expressed in this podcast are not to be taken as either trading nor financial advice. Neither the announcer nor the Sirius Report make any claims to be certified financial advisors, and all reporting is dedicated solely towards being both informative and educational. Greetings, everyone. Good afternoon, and welcome to the Sirius Report Market Wrap-Up for Wednesday, October 30th, 2024. A lot of interesting news. We got economic data, we got GDP, but we have more things going on in bond markets, both in the US and in the UK. We have gold reaching another new all-time high, a little bit of a pullback for Bitcoin, and subsequently, are we at the beginning of a debt crisis? So with this in mind, let's go ahead and jump right in and see how the markets fared. Taking a look at the Dow. Well, the Dow was up for probably 2/3 of the day in the green, but ended up having a sell-off going into the close. It ended up down 91 points to close out at 42,141. And for the first time in a while where the Dow was in the red, both the S&P 500 and NASDAQ also are in the red. NASDAQ was down 104 points to 18,607, while the S&P 500 was down 19.25 points to close at 5813. Meanwhile, in the bond markets, well, after yesterday's auction that led to a decline in yields, those yields are back up with a vengeance. The 30-year remains above 4.5%, but the 20-year has now inverted with the 30-year 4.627%. The 10-year is back to 4.3. The 2-year is at 4.174. This is one of the more interesting things is the Fed cuts the rates. We have not had a steepening of the 2 and 10s. We have instead had an inversion. Okay, what was I talking about with the UK? Well, if actually there's an upcoming podcast that Paul and I recorded. It should be out, let's see, probably Friday. And it's talking about financial things. And one of the things we were talking about was an interesting case out of the UK where the minister over the budget said that they were redefining what the definition of debt is. Well, why are they doing this? Because according to their laws, once the debt ratio gets to a certain point, they can no longer borrow anymore. So just to sustain their government and to try to stimulate the economy, they are redefining the term debt so they can skirt around the law and borrow into oblivion. And that's exactly what is being put here. The concept of debt to allow the UK, which already exceeds 90% debt to GDP threshold, that is estimated by both Reinhardt and Rogoff, who are two U.S. economists who have pointed out the significance of that 90% debt to GDP. Let's see, the Keynesian multiplier falls below 1 when it gets to 90. Now, what that means is that once you get 90% debt to GDP, every dollar, or in this case, pound sterling, that you create out of thin air / borrow through your debt markets ends up getting quantified or exponentially over time less output than for the input. So for every dollar it puts in the economy, it starts getting less than $1 of GDP growth. And so once they've got to that 90%, we in the United States are at 123%. Japan is well over 250%. So every dollar that they stimulate probably gets less than 10 cents into the GDP. But they want to borrow an additional $90 billion in debt, a gimmick which only a politician could possibly think is a good idea, especially when you have to redefine the terms debt. So the UK is at the point that they have crossed over the Rubicon, and for every debt or dollar that they or pound that they borrow, it's going to have less and less effect on the economy, but it's going to have greater effect on inflation, which moves us over to the United States. According to the Treasury, they're going to hold debt sales steady for at least several quarters. So here's the conundrum. the Treasury is going to keep printing money. The government's going to keep spending money. They're already at 123% debt to GDP to debt income ratio. And in Q1 2025 alone, the Treasury expects to issue $823 billion in debt. Multiply that by 4. And the deficit, it looks to be $3.2 trillion or more. Actually, about $3.3 trillion is what's expected for the government going forward. That's going to increase the GDP to debt ratio even more, which means that inflation, the only outcome is expected inflation. Treasury knows this. Well, you got Yellen in there, and she thinks that money grows on trees, so you can print it to oblivion, QE infinity. Powell is probably doing what he normally does. He's hoping that eventually the problem will go away. And of course, Congress is so old, they've already made their millions. They don't care what happens to the economy. They're ready to move off and fly off to their safe haven homes. Looking at the dollar, well, we had a decline in the dollar today, almost falling. Well, actually, about 2 or 3 times we did fall below the 104 handle, only to see it bounce back and recover. Dollar was down 22 cents on the DXY in relation to a basket of Western currencies, closing out the trading session at 104.10. Meanwhile, interesting day in the gold and silver markets. Gold was actually up, set a new high, and almost crossed over into $2,800 an ounce. It did get beat down a little bit, but not much. They've almost decided to give up on it, seeing it recover to close out the day up $12.50 at $27.88. The intraday high is $27.90, and you can see the closing high is pretty close to the all-time high that is intraday. In the silver markets, well, silver got beat down more than $1.20 at one point before it recovered. It ended up down 65 cents to $33.86 with a low of $33.35 and a high of $34.57. Meanwhile, mining stocks were beat as well. So somebody posed a question on Twitter. They've likely, because of the amount of gold that's being purchased by central banks, by BRICS nations and the global south, they've probably given up on trying to dispel the price of gold and are instead dedicating their efforts towards the paper price of silver and, of course, the mining stocks, which are themselves paper. In the crypto markets, well, after getting up to 73,000 yesterday, Bitcoin had a slight pullback while Ethereum had a little bit of a gain. Bitcoin for the last 24 hours trading was down 0.52% to 72,340, while Ethereum was up 0.8% at 2658. In the oil markets, we had a little bit of a rally today, both in WTI and Brent. WTI was up $1.40 to 68.61, and Brent crude was up $1.93, closing out the session at 73.05. Some economic news for the day. October surprise, maybe a little bit too late with less than a week before Election Day. ADP employment report signals a 6 sigma beat, a monstrous doubling of the highest expectations at a time when businesses and corporations are laying off people en masse. Let's see. ADP's employment report shows an addition of 233,000 jobs in October, more than double the 111,000 expected, and September, of course, was revised higher. This is the biggest monthly addition since July of 2023, and the question will be next month, after all the dust has settled, will these be revised much, much lower? You could almost guarantee it. Well, we had GDP come out for Q3. It disappoints despite surging personal and government spending. Just moments after the ADP published its private payroll report, the U.S. labor force grew by, I don't want to go into that again. The Bureau of Economic Analysis, which is also a government agency, came out with its own surprise when it reported its first assessment of Q3 GDP, having the U.S. economy grow at a 2.8% rate but which is down from 3% at Q2. And it's interesting that they decided to allow the number to fall below 3% because that's what most of the analysts were expecting. In the housing market, well, where we had new home sales fall immensely yesterday, pending home sales exploded higher in September as mortgage rates in that month fell, but of course we know mortgage rates are back up. Existing home sales slumped to a 14-year low. I'm sorry, it wasn't new home. It was existing homes that did, but new home sales surged. So today's pending home sales data is the tiebreaker for which the U.S. housing market is. And the winner is pending home sales surged 7.4% month over month in September, well above the 1.9% expected, and the biggest month-over-month jump since the COVID lockdowns of June 2020. So everything is shiny and happy just a week before the elections until reality strikes next month in the numbers. Well, as I mentioned, we want to take a look at something that's beginning to rear its ugly head. The question is, of course, will the media cover it? No, they'll probably wait until the crisis is upon us and then wonder what happened. We're going to take a look at something from Rabobank, where they were talking about, is this the beginning of a debt emergency? What I'm talking about, of course, is the interesting thing about the 10-year, and we focused on the 10-year last few market wrap-ups. Since the Fed lowered and cut rates by 50 basis points, 10-year yields are up more than 55 basis points since that cut. We have a 7% mortgage rate, and curiously, as I mentioned, the 2 and 30 spread has not steepened since the Fed cut rates, which is something that rarely, if ever, happens when we start cutting rates. Let me see here. Here's one of the more important things. Okay. In layman's terms, this means, of course, that every extra dollar the government spends, GDP increases by less than $1. So let's take three things we talked about today. The debt to GDP ratio is 123%. At 90%, you get diminishing returns. For every dollar you borrow, you get less that is put into the general economy or the financial system. You get less than $1 in return on GDP growth. We have expected for the first quarter, the Treasury is going to do $823 billion of new debt, of which very little of that is going to actually, a smaller percentage, probably along the lines of between 40 and 60% of that money will go into and increase GDP. And of course, we've got the increase of the national debt, the government spending going to $3.2 trillion right now without any conflicts or things like another hurricane causing an increase in spending. But what does it really mean? It means inflation is going to be here while stagflation in the general economy increases even greater. So it's not going to be the best days no matter who wins the presidency. Anyway, I want to thank everybody as always for stopping by to get your market wrap up for Wednesday, October 30th, 2024. Appreciate everybody here supporting the Sirius Report on YouTube. Don't forget to subscribe, like, share, comment. Share this out to anybody you think this might be important to. And until the next time we get together, everyone, have a great Wednesday.